And a happy St. Patrick's Day to everyone as we end today's trading session fittingly in the green. Dow Jones Industrial Average ends the day higher here. Brad Smith here with Rochelle Akufo, and we're giving you a look at where the U.S. markets, the major averages at least, end the day, and all in positive territory. Up is where we find the Dow Jones Industrial Average by about 1.2%, 416 points to close out the day. S&P 500, that closes up by about 53 points. 1.25% will round that off to in positive territory and also in the green. We've got the NASDAQ, the tech-heavy average, 178 points to the upside there, 1.3% in positive territory. So for more on the markets and today's trading activity, we've got Paul Schatz, who is the Heritage Capital founder and president, plus Christian Ledoux, who is the CAPTRUST Director of Investments, joining us here today. Great to have you both. Paul, just to kick things off with you, our own Jared Blickery was breaking down some of the ranges going into the close and what we should watch more longer term. Quite frankly, where we closed on the day, 44.11 on the S&P 500, that still puts us over this broader month period towards the top end of where we've seen this range. And so what is the expectation from here? Is this momentum, or is this another opportunity that some may see, given the profits that could be taken at this point, to take those profits in this interim wavering period?
There's a lot to unpack there, but let me start by saying this. A lot depends on your time frame and time horizon. If you're a nimble short-term trader, absolutely for sure, this close is the time to take some chips off the table. Now, that's not most people. If you have a little longer term time horizon, I wouldn't start dumping money. We've had a really nice 3-day rally. We'll see what the closing numbers are. But what you want to see off of lows, you want to see a thrust of buying. You want to see the buyers literally step on the throats of short sellers and not let them breathe. That creates phenomenal momentum, which is what you see off of every durable bottom. Right now, the January 24th low was the low where we saw the most carnage. February 24th was that secondary low. And most people don't even realize February 24th was the lowest price level. So we're still creating this more complex kind of low that requires patience. It's frustrating a lot of people. But this is the first rally we've seen since probably the month began that has any kind of staying power possibility beyond just a couple of days.
And Christian, in your notes, you talk about thinking about the stock market as a discounting mechanism that reflects the realities 6 to 9 months ahead of time. So with that being said, how much of the pain has already been factored in versus perhaps volatility in terms of what to expect from Fed rate hikes and the uncertainty that we have from how the trickle down might impact from the Russia-Ukraine fallout?
Yeah, this is, in my book, an oversold rally here. We had about 25% declines in the average stock out there in the market, even though the market cap weighted indexes are down a lot less. And that's really reflecting the fact that people are anticipating the Fed moves that we've seen. And I'd say they've even gone a little higher on their expectations for increases for later in the year. But really, it's a path of inflation you have to watch. And our view is we haven't had the easy comps of big numbers in the past year yet. And once you get into the late summer and early fall, I think we're going to see those headline inflation numbers come down. And that may let the Fed take their foot off the gas a bit. And maybe that gives a spark for a new rally.
Christian, just to stay with you for a hot second, we haven't even gotten to earnings, where companies who have already had to monitor the current quarter impacts, where they're going to have to update some of their guidance for the rest of the year with the added part of this broader kind of fabric that we've been watching be threaded in front of our eyes of the geopolitical tensions and any impact to oil prices that may also impact their supply chain mechanisms. What are you going to be watching for there?
Well, I'm looking for staying power, and I'll give you an example from last night. Williams-Sonoma reported as a mid-cap company in the retail space, and they're guiding for more growth this year. And that's something that's hard to do after a big gain from last year from people stocking up for the pandemic. This company sells furniture and kitchen gear. But this is a company that's able to produce that growth, raise prices, which is another factor I really look for is the pricing power. And that gives you the sense that these are durable earnings growth that we'll have this year, at least in some of the companies. You've really got to pick and choose, though.
And Paul, as we look at inflation and how consumers perhaps are starting to feel the pinch, they're starting to pull back a little bit. We're seeing a dampening of sentiment there. How do you see that if inflation continues? How do you see that perhaps denting company earnings?
So I will take the very anti-consensus contrarian view, which I started in October, and I said inflation was going to peak early in 2022. And I still feel that way. I think that inflation, I did a report about a week ago where I wrote all about oil peaking. I think it's possible that we've seen the oil peak. If not, there's one more rally left. I think inflation, once it becomes omnipresent, once it hits the cover of Time and Newsweek and everyone's talking about it at the gas pump, that this feels a lot like 1990 when Iraq invaded Kuwait. It feels an awful lot like July of 2008 when oil hit 147. The huge moves in inflation, the huge moves in energy are ending moves. They're not beginning moves. So I think we get a reprieve in inflation. We get a reprieve in oil prices as the year goes on. But the damage to the consumer psyche has already been done. To your point about corporate earnings, I said coming into the year, GDP growth is going to slow. It's a front-loaded year. Earnings growth is going to slow. We're going to see the best of the year now, and it's going to slowly get worse and worse.
And so as we look ahead, then, we're thinking that perhaps the Fed might not need to raise interest rates by as much, depending on how some of these other headwinds factor in to inflation as well. What are the other headwinds you're watching, other than the Fed tightening and, of course, inflation rates going down? What should you be keeping an eye on?
I think you hit the nail on the head. 80% of this decline is Fed-related and inflation-related. It's not Russia. It's not Ukraine. Investors taking their eye off the ball. The most important thing now is growth slowing.
All right. Thank you so much. We do appreciate our market panel's time today. Paul Schatz there, Heritage Capital's founder and president, and Christian Ledoux, CAPTRUST Director of Investment. Thank you so much.